Hello and welcome back to our second video lecture dealing with chapter 12, which is all about the statement of cash flow. In this video, we're going to see how we prepare the statement of cash flow using the indirect method. Now, remember, the indirect method only applies to the operating section, okay? Oh, sorry about that. Okay. So the first thing we need to look at is the operating section, right? And we need to identify what's our starting point, figure out what are the adjustments in the accruals that we have that actually convert our accrual accounting to the cash basis. So when we're preparing the statement of cash flow, basically what we're doing is we're taking our financial statements, the income statement, and the balance sheet, and statement of owner's equity. Those are all prepared using the accrual basis of accounting, right? Now we need to convert that to the cash basis, okay? So we always start off with the accrual net income, right? So we look at our balance sheet or we look at our income statement and we say, okay, what is net income? Remember, that net income that we arrived at is based on accrual accounting. So there's going to be some non-cash expenses in there. There's going to be some adjustments that we made, and we need to convert those to cash, okay, or to the cash basis. So the first thing we do is we start with net income, okay? Second thing we do is we're going to either add or subtract the differences between the accrued revenues and gains and any operating cash inflows. The next thing we're going to do is we're going to look at the difference between expense and losses in the operating cash outflows. Okay, and we're going to add or subtract those. Then finally, we end up with cash flows from operating activities. Now, this is as clear as mud. I get it. It is not that difficult for us to prepare, as long as you know that the first thing we need to do is start with our net income. That's number one. Number two is we need to add back any non-cash expenses, and then we look at the difference between our assets that we use for operating. Okay. So again, what do we need in order to prepare the statement of cash flow? Well, obviously we need the income statement because that's our starting off point. We need to pluck off that net income or net loss. We need a comparative balance sheet, right? We need to see what the beginning balances are of our assets, what is our ending value of our assets, and calculate, was there an increase or a decrease, okay? And then finally, we may need some additional information that are withheld in the company's financial statements, things like any notes on any non-investing or non-cash investing in finance activities. Okay? So basically, we have to calculate what are the change in cash. Okay? So what's our change in cash from all the other balance sheet accounts, right? So basically, we're going to take our accounting equation, assets equal liabilities plus our shareholders' equity, and we're going to separate assets into current assets or, cash assets and non-cash assets, right? So we're going to look at all the cash assets that we have. Then we're going to look at all the non-cash assets we have, and we're going to kind of separate those two out, okay? Basically, at the end of the day, what we need to do is take any changes in cash assets is going to equal any changes in liabilities minus any changes in their non-cash assets plus any changes in stockholders' equity, okay? Trust me, once we put this thing together and you see this thing work out, it'll be a lot clearer. So what we have here is an example of a comparative balance sheet, right? we see our assets, total assets. We have our liabilities. We have our owner's equity. We have from 2015 into 2016. Okay, so right off the bat, look at cash. Cash changes. It increases, right? $8,000 to $25,000. Okay, that's good. What we're going to do is determine, where did that cash change come from? Is it because of operations, financing, or investing activities? Okay, so again, first thing we do is we start with our net income, right? We have the income statement here. We have our revenues, cost of goods sold, gross profit. Check it out. All of our operating expenses, right? Wages and salaries, selling and administrative, all those expenses, okay? Then we have our statement of shareholders equity. And we see that the retained earnings actually changed, right? We started off with $21,000. I'm looking here in the middle. We add our net income. We subtract out any dividends paid. We see that the balance of our retained earnings at the end of the year is $39,000. Okay? So here's the 5 steps, right? This is very important. First thing we want to do is we want to calculate the change in each of the balance sheet accounts, excluding cash. Okay? So what we want to do is we want to say, okay, accounts receivable. Well, yeah, that went up $5,000. It was $35,000. Now it's $40,000. Look at inventory. Inventory was $31,000. It went up to $55,000. So we have an increase there. Look at our prepaid rent. It went down. It was $24,000. It went down to $12,000. So we have a decrease of $12,000 in rent payable. Okay. We do the same thing for all these assets, right? Even our liabilities. Look at accounts receivable or accounts payable, that went up, right? Went up what? 11 grand. Look at taxes payable, those went down. So that's really the first step that we need to do, is we need to calculate the change in each of the balance sheet accounts. Remember, cash is not going to be one of those things that we're going to calculate the change in, because at the end of the day, we're taking net income, factoring in all the net changes from all those activities. That's going to tell us what our ending cash balance is. Okay. So once we calculate the change, we're going to look at all of the balance sheet accounts and we're going to put them into one of the 3 cash flow activities. Is it operating? Is it investing? Is it financing? Okay. So then what we're going to do is we're going to prepare a preliminary statement of the cash flow. We're going to integrate the income statement data into the preliminary statement, and then we're going to take out any non-operating or non-reoccurring items. Okay? So let's look at number 1. Step 1 says we need to calculate the change in each balance sheet accounts. That's so easy to do. We just subtract the beginning balance from the ending balance. That tells us if it increased or it decreased. Okay? When we look at investing activities, we're going to simplify this. We're not going to look at each asset. We're going to look at them as a whole, right? So we're going to take the net PP&E together before we determine any changes. Okay? And then the other thing that we need to do within this first step of calculating those changes in the balance sheet is to verify that the net change in assets will equal the net change in liabilities and shareholders' equity. Okay? So we're just making sure that that accounting equation holds. So here's the product, if you will, of step 1, right? We look at the change from the beginning to the end of the period. We take the beginning, subtract out the ending, and that tells us if that account went up or went down. That's it. Pretty simple, right? Second thing we need to do is we need to identify the cash flow activities for each of the balance sheet. Remember, operating activities, financing activities, and investing activities. Operating activities are associated with those day-to-day operations, right? What do we do in our core business? Well, we sell stuff, okay? Any expenses that we incur as a result of buying and selling stuff is an operating activity. Financing activities are associated with raising capital to finance the business. Are we issuing stocks, bonds, things like that? Investing activities, those are associated with any sales or purchases of any long-term assets that we actually use to run the business. So we call these revenue producing assets, right? Okay. So then what we need to do is we need to look at any long-term assets, right? And any long-term assets, we really have two cash flow activities, okay? We have the investing activities, actually buying that piece of equipment or selling that piece of equipment. And then we have operating activities that are associated with those revenue producing assets. Things like expenses, right? Depreciation expense or amortization expense, right? Remember, these are non-cash expenses. These are deductions that we use as an operating expense in order to calculate that accrual net income, right? It has nothing to do with the actual cash flow, depreciation, amortization. It has to do with accrual accounting, with GAAP, and matching revenue or expenses to the revenues that those expenses help generate, okay? So once we go through and we pick each item we have, okay, so accounts receivable, that's going to be an operating activity. Inventory, definitely going to be an operating activity. Prepaid rent, definitely going to be an operating activity, right? Long-term investments, that's an investing activity, right? Equipment, well, equipment could be operating and investing. Same thing with intangible assets, operating and investing. And the operating portion of those are the depreciation that we take or the amortization that we take. The actual buying and selling of those, of that equipment or that intangible asset, that's the investing portion, okay? All our current liabilities, all examples of operating activities. Accounts payable, that's an operating activity. Taxes payable, definitely an operating activity, right? Loan payables, right? We have a loan, that's a financing activity. Loan payables that are non-current, also financing activities. Any changes in common stock, guess what? Financing activity. And then retained earnings, again, we're either looking at operating or financing, okay? So here's the preliminary step that we create, right? We have to create a preliminary statement of cash flows. Basically, all we need to do is just group the activities by the type and list the amounts. That's it, okay? Okay, so remember that net income really increases our retained earnings. Any dividends that we pay, those decrease our retained earnings. So when we're looking at retained earnings, we have to look at what piece is it? Is it the dividend piece or is it the income piece? That dictates if it's operating or that dictates which portion is operating and financing. Okay? So notice what we have here. We have our non-cash adjustments that we need to make. Remember, those depreciation expenses, those amortization expenses, we add those back into operations, okay? Because those are non-cash transactions, right? I'm going to show you an easier way to do this. There's really, notice they have a preliminary step. Let's go back. Starts with retained earnings and then factors in all the changes in operating assets and operating liabilities. Yeah. It's easier if we actually really just start from step 4. Step 4 says start with your net income, add back any non-cash expenses. That's going to be the depreciation and amortization, okay? We need to plug in our dividend payments in operating activities. The financing activities, we need to subtract any non-cash expenses from that net income, which we did up at the top. And then here we have the changes in our long-term investments in PP&E. Okay. Another thing that we want to do, and this is actually the last step, we need to remove any effects of any non-operating as well as non-reoccurring transactions that hit our income statement, right? We may have gains or losses on the disposal of equipment or any long-term assets. We need to remove that, okay, from our net income. Why? Because we want to put everything on the cash basis strictly from operations, and those non-reoccurring items like selling equipment, it's not in our core business. It's just a peripheral activity, so we need to get it out of there. Key step, you got to add any losses or loss from disposal of equipment or long-term assets. You need to add that back to net income. We remove gains. How do we remove a gain? Subtract it from the net income. So this slide is really, really important, and I would definitely make sure you have these in your notes and understand how we get rid of those non-operating and non-reoccurring transactions. Okay? So here, just kind of a quick one-over on the steps of how we prepare the statement of cash flow. When we go through an example, I'm going to show you a little different way, but at the end of the day, it gets the same results. Okay? So which of the following would appear as an addition to net income on the indirect statement of cash flow? Well, let's think about that. We're going to go through each of these individually. What do I add? What do I subtract? But we know right off the bat, we need to add back any non-cash transactions. So we're going to have to definitely add back depreciation, right? A decrease in accounts receivable. Well, let's think about that. As our accounts revenue goes down, right? What happens to our cash? Well, our cash should go up. So the answer is actually D, both A and B. Think about accounts payable. What happens to accounts payable is we pay them. Well, we're using cash to pay those accounts payable. Okay? When we come back, we'll look at some of the ratios used to analyze the statement of cash flow. But again, the most important thing is putting together that statement of cash flow. So when we come back, what I want to do is work on a little example of how to prepare the statement of cash flow using that indirect method. Okay? So tune back in for that one.